Welcome back. You're watching Market Moves. Our guest today, Roger Montgomery from rogermontgomery.com. Looking at Santos, what are your thoughts of where it's trading at the moment?
Well, it's easy for me to tell you that it is very, very expensive compared to its intrinsic value. The business last year raised, I can give you an exact number, it raised an additional $3 billion from shareholders in the 2009 financial year. So you'd expect that if you give me $3 billion and I put that in my bank account, the interest that I earn on my bank account is going to go up. So I would hope that Santos's profits go up because people have given them an extra $3 billion. So they better go up. The problem for Santos is that its return on equity expected over the next couple of years is circa 4 or 5%. Not much more than you can get in a bank account. So given the risk, execution risk, management risk, stock market risk, all of those risks, and you're only getting a return on equity of 5%, well, why wouldn't you just have your money in the bank? So the shares are expensive.
$13.55 today?
Yeah, compared to a value of about $5.
Right, okay.
It's embarrassing, I know, and people will say that guy doesn't know what he's talking about. What's he talking about? An intrinsic value of $4.70 for Santos when it's at $13. But that's a similar value to, that's a value that I had on Telstra when it was trading at $9. You know? So, look, the value is based on the performance of the business. The performance of the business isn't that great, so there you go.
Okay, all right, Santos there. Just looking at Lynas, if we could, I mean, up strongly on high volumes. Often that's seen as something, you know, very positive about a stock if that's the way your investment strategy works. But looking at the way you invest in the market, what do you think of the rare earths miner?
I'm pretty certain, if I have a look, I'm pretty sure we're going to find it hasn't actually made a profit for a very long time. Yeah, no, there's no expectation that it's going to make a profit over the next 3 years. Yeah. Look, I have a very simple approach. I turn the stock market off and focus on businesses as opposed to stocks. Now, people might trade this stock and they might make a lot of money because the share price goes up. But for me, that's a little bit like putting some money down on black and spinning the wheel and hoping that it lands on black. The business isn't forecast to make a profit, and so its value, the way I value a business, is zero. I'm sorry, you know, about that, but that's just how I buy businesses. Yep. Yeah.
So one that you do not look at then because of that.
The interesting thing, let me just add. Yeah. The interesting thing is, no, I wouldn't look at it to buy it. I mean, I can give you a whole bunch of statistics on it. Yeah. The interesting thing is, someone may come along and make a takeover bid for this thing, and my response to that is, well, let them have it, you know, and anyone who owns the shares should sell them to the buyer. I can't forecast where the price is going to go. I can't forecast what some other company is willing to pay, but I can tell you based on an ongoing concern basis that it's not worth anything at the moment.
Just wanted to turn to the miners if we could, BHP and Rio, if we could start with those. We've seen production numbers recently. Just wanted to get your thoughts on their intrinsic value at the moment.
The interesting thing about these businesses is BHP is the superior business on a quantitative assessment of its balance sheet, its profitability, the level of intangibles, the level of debt, then BHP is the superior of the two. Both of them are engaged in a business that ultimately will depend on China for their futures. So if you like these businesses, you've got to be fairly certain that someone like Jim Chanos, who runs the biggest short fund in the world at Kinnikos, that he's wrong about China. So he is shorting, this is my belief, you know, don't hold me to it, but I believe he's short Rio and short BHP, and he's been short for some time now, expecting the property bubble in China to burst, and the impact on the demand for our raw materials as a result of that will slow. So if you believe the China story and you think that China's going to be a great country for, you know, for 50 years, and I don't disagree with that, you just have to be mindful of the fact there could be speed humps along the way. BHP and Rio are very exposed to the outcome of Chinese policy making, and so look, both of them are trading at a bit of a discount to intrinsic value at the moment, but those intrinsic values are based on analysts' expectations, and analysts are fairly bullish at the moment. There was a really neat little report that came out from McKinsey's recently in their quarterly report, I think it was, and it talked about the persistence of optimism in analysts' forecasts. And they said that on average, analysts, and it is an average, but on average, over a very long period of time, analysts are about 100% wrong with their forecast. They tend to be double. They tend to, revise down their estimates for earnings. They didn't talk about individual examples, but for BHP, you've just got to remember that while they're at discounts to intrinsic values at the moment, those intrinsic values are based on fairly optimistic forecasts. Looking at
some of those smaller or mid-cap iron ore miners, obviously we've been hearing from Fortescue's Andrew Forrest today. Sure. There is that threat out there. They are not happy with the revised MRRT, sure, as it's now known. What about Fortescue? Because obviously it's seen a bit of a fall today. Oh, right, OK.
It's quite expensive,
$4.04 where it finished. It was down about 1.5%. Worries, obviously, about this MRRT, talk of restarting the advertising campaign against the tax proposal. Yeah, it's trading at, I've got an intrinsic value on it of about $2 and it's trading at $4.10, or is that right, about $4.10? Yeah, $4.04 today.
$4.04, so it's trading at double its intrinsic value. But Australians love a growth story and we don't have many stocks to buy, so fund managers and investors are forced to buy from a very small universe of stocks. If I was in control of the universe of stocks that everyone could buy, there'd be a very small handful. So unfortunately, they're forced to buy things. Okay.
All right, let's just turn now to our small cap star segment for today. And you've got a couple of stocks to talk about today. Yeah, look, subject to China's property bubble not bursting. So the caveat is, if it bursts, all bets are off. There's two sort of engineering mining services companies, Decmil and Forge, and I think in the universe of companies that I look at, both of them are A1 in terms of quality. Both of them are trading at discounts to their intrinsic value. But both of them generate very high rates of return on equity. So there's two examples of companies that other people might not have heard of, but they are both very good businesses. Decmil arguably is at a bigger discount to its intrinsic value, and some of my friends in the industry would argue that it's the better quality business of the two. Just both of them, I think, are very good quality businesses and trading at discounts. Don't rush out and buy them though unless you do your own research. Absolutely, that is always the caveat. DCG and FGE, the two ticker codes there. 10 is a bit of a darling at the moment, isn't it? I think most brokers have either a buy or a hold on it. What do you think of 10? Oh, look, this is a business that I can't seem to understand what all the fuss is about. This is a business that's trading way over its intrinsic value. It produces returns that are subpar. For me, it's not even investment grade. Let me give you some numbers here. Back in 2005, it earned $105 million. This year, it's forecast to earn about $98 million or thereabouts. But 5 years ago, 2005, it did that with $400 million of debt and about $480 million of equity. It's now got double the equity and it's generating a lower profit. So they're not the metrics of a great business. I think what's happened here is, we've got a real fragmentation of eyes. We've got pay TV or subscription-based media, as is the politically correct term. We've got the internet, YouTube, Facebook. People are doing a whole bunch of different things. They're not just watching television. And I'd be very reluctant to buy a business just because it had one good program. And everyone's talking about that program. I'm talking about the great debate that's coming up on the weekend. Yes, absolutely. Yeah. Not MasterChef at all. No. And so, this business generates mediocre. It's mediocre in terms of its performance, and it's expensive in terms of its value. Roger Montgomery, always appreciate you coming on the show. Thank you so much. It's a pleasure, Bridie. Roger Montgomery there from rogermontgomery.com.